Now let's talk about that lifetime credit / unified credit. We were kind of referencing it, but now let's dive into all of it. The lifetime credit, also known as the unified credit, it's a tax provision in the United States, shocker, we're dealing with the US here, that applies to both gift taxes and estate taxes. It allows individuals to give away a certain amount of their assets tax-free during their lifetime or upon death. Now, the unified credit is a way to combine the gift and estate tax exemptions into one, making it simpler for taxpayers to understand and manage their tax liabilities. You can see how gift taxes and estate taxes could be quite similar. You're trying to give away your wealth and you're trying to not pay tax on it and transfer it to another generation, just transfer it to other individuals. And we're going to tie these in together. This is an amount that you will have to memorize as well, so definitely do so. I believe when it was established, I believe this had to do with the Tax Cuts and Jobs Act. It was around $11 million. And how does it work? Well, the lifetime exemption, the IRS sets a lifetime exemption amount that can be used for both gift and estate taxes. It's adjusted periodically for inflation. As I said, we had it established and we want to memorize the current value of it as it changes. When a person makes a taxable gift during their lifetime or leaves behind a taxable estate, upon death, the exemption amount can be applied to reduce or eliminate the tax liability. The annual exclusion, in addition to the lifetime exemption, we have the annual gift tax exclusion, which is what we've been referencing, whether it was that $15,000 example or the $16,000. This means that an individual can give away up to that amount per year without incurring any gift tax or using up any of the lifetime exemption. So what we're seeing here is that there is this exemption that is kind of like another barrier. It's another safe way to give away your funds without having to pay tax on it. Now, you don't want to use it if, let's say you are, your grandparents right now, you and your spouse, your grandparents, and you're trying to give away your wealth to the next generation. The best way to do it would be to give away every single year to as many people as you can, up to that annual exclusion. Let's say it's $15,000. So you want to give your son, you want to give your daughter, you want to give your grandson, you want to give your niece, nephew, everyone $15,000 in value, whether it's cash or property or anything like that. And then if, unfortunately you pass or you know you're going to pass, then you give away the rest of it, and that will start to eat away at that. And we'll just call it, $11 million. That's about what it was when it was established in that lifetime gift tax exemption or this unified credit. And that was not tax advice. This is just me explaining how it works. Look into it for yourself if you want to understand how to avoid taxes or not avoid them negatively, but use the tax code to your advantage. Now, the unified credit application, when a person makes a taxable gift that exceeds the annual exclusion, they have to file a gift tax return. Now, let's just think about this. If you're dealing with massive trust funds or someone who's got $30 million in the bank, yeah, you're going to probably go over this lifetime exemption if you are distributing that to someone all at once. And you're going to use a portion of their unified credit to offset the gift tax. If let's say the lifetime exemption is $11 million, you haven't used any of it in your lifetime, and you're giving away $30 million in value, you're going to say 30 million minus 11, and that remainder is what you are going to have to pay tax on. Now, as the unified credit is used during a person's lifetime, the remaining credit available for estate tax purposes is also reduced. As we said, this works similar for both gift and estate. It ties in. It's whether it's estate being distributed or gifts being distributed, it is the same thing. The implications for estate tax, well, upon a person's death, their estate will be subject to estate taxes if the value of their estate exceeds the remaining unified credit. So again, like I said, if you die and you have, the morbidity in this exam, it's just so morbid, it's so awful dealing with these topics. You got $40 million of value, and like I said, let's just use clean numbers. Let's say it's 10, that's the lifetime, you haven't used any of it. So what are we going to have? We're going to have $30 million of value of assets to tax. The estate tax is calculated on the estate's value above the remaining exemption amount. If the individual has used up their entire credit during their lifetime through taxable gifts, the estate may be subject to the full estate tax on the value above the exemption amount. So it really works similar to any other exemption, except this is a lifetime exemption, and it's up to you to keep track of it. Make sure you're doing that right. Gotta love it, the fact that everything tax-wise, it's up to you to keep track of. Now, in summary here, the lifetime credit, also known as unified credit, this is a tax provision that applies to, remember, both gift and estate taxes. So whether you're giving away gifts or you're dealing with your estate being given away, it's going to both be treated the same. It allows individuals to give away a certain amount of their assets tax-free during their lifetime or upon death, because estate is upon someone's death. The lifetime credit is a part of the unified credit, which combines the gift and estate tax exemptions, making it simpler for taxpayers to manage their tax liabilities. Now, is this the most simple way they could have done it? I don't really think so, but hey, I'm not here writing the tax code. All right, moving on. We've got a few more slides and we'll be able to call it a day. We got an example here, gift tax with the lifetime credit. So we saw an example before without it, before we mentioned it. Now that we know what it is and we're dealing with it, we will talk it through. As mentioned, we really don't need to worry about these rates. This is just here. This is just how it would work. Now assume that John has not used any portion of his lifetime gift tax exemption. And in the current year, he wants to gift $1 million to the daughter, Jane. First, we want to calculate the taxable gift. So in this year, we've got $1 million of gifts, and we're saying that the amount is $15,000 of annual exclusion. So our taxable gift is $985,000. Then what's the tax rate? Again, the question, if they even dealt with this, which I can't imagine you're going to have a multiple choice question that deals with it, it will give you the percentage. So we're going to say the gift tax rate is 40% for gifts over $1 million. The gift tax owed would be $394,000. We get that by taking 40% of 985. So you see, it's really wild just how much money gets taken away when it comes to transferring wealth after death or gifts or anything like that. Then we want to apply the unified credit. Since John has not used any of his lifetime gift tax exemption, he can apply the entire unified credit amount of $11.7 million, which this is the amount we're just using for this example. The credit amount applied to the gift tax owed is calculated using the same tax rate. So we're going to say $11,700,000 times 40% gives us this $4,680,000. Now, how are we going to determine the net gift tax owed? Subtract the unified credit from the gift tax owed. So we say $394,000 minus the amount we calculated above. That gives us negative $4,286,000. Now, in this case, since the unified credit is greater than the gift tax owed, no gift tax is due. You might be like, all right, Nick, why'd you put this in a negative? Well, it's just how I wanted to portray it. This is the remaining that you will be able to use in the future to offset. There we go. Update the remaining unified credit. Since John has used $985,000 of his unified credit, his remaining lifetime gift tax exemption is now $10,715,000. Pardon, this was the remaining after taking into account the gift tax. So what we actually have remaining is this $10,715,000. So, but this is the using it with a 40% tax rate. In summary, John can make a $1 million gift to Jane without incurring gift tax, thanks to the unified credit. Thank you, unified credit, everyone out there. Make sure you say a prayer. Thank the unified credit. The remaining unified credit that John can use for future gifts is going to be this $10,715,000. That's how it works. Just not like you'll have to likely do this for a sim or anything, but making sure you understand just overall how this process works. In my mind, the best way to understand something conceptually is to also see how it works mathematically, numerically.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.